All right, today we're going to be learning about the second part of 4.6, which is monetary policy and ample reserves. So, I hate to tell you this, but everything I told you yesterday in 4.6 part 1 is actually a lie. It is not currently happening in the United States. So we learned yesterday about the 3 tools of monetary policy, which is the reserve requirement, changing the reserve ratio, the discount rate, which is the rate at which the Fed loans to banks, and then banks can loan to us, and open market operations, or the buying of U.S. Treasury securities and bonds. So all of that kind of went to crap in the Great Recession of 2008. So I have a graph here to kind of show you. Limited reserves, meaning banks do not keep a lot on reserve and they don't have a lot of reserve in the Fed. Banks can have accounts in the Federal Reserve in which they keep excess reserves. And it's just like a safe way to keep excess reserves and a way for the Fed to kind of like keep an eye on them. So banks had very limited reserves up until the Great Recession of 2008. And because of hey, we need to fix this so it doesn't happen again, the Fed started doing something called interest on reserves. So I'm going to call that IOR, interest on reserves. And they will actually pay banks a little bit of an interest rate to keep excess reserves in the Federal Reserve in an account with like the bank's name on it, if that makes sense. That's a way of like dumbing it down essentially. So banks are now like, oh, we can grow our money by putting it on reserve, putting our excess in reserves in the bank, in the Federal Reserve. And so banks became more interested in that, and we see a lot of excess reserves being put in the Federal Reserve. And so we call this monetary policy in ample reserves. So from a long time ago to 2008, that's limited reserves, and that's the tools that we talked about yesterday. And then from 2008 to the present, it is the way to administer monetary policy is not those 3 tools. It's by changing interest on reserves, and that's through a different graph that we're going to learn. Now, I'm going to go ahead and tell you, AP just added this 2 years ago. So this is brand new to kind of everyone. And since they added it 2 years ago, it has been on the free response every year since, which is extremely rude because they haven't quite decided what they want on the graph. And there's lots of different ways to label the graph. It's going to be very annoying, but stick with me. Okay, so you need to know some words here that I just said, and they're kind of like scattered, I'm so sorry, throughout your notes packet. So interest on reserves is basically what I just said. Banks can choose to keep their excess reserves in the Federal Reserve, and the Federal Reserve will pay them a small interest rate. Let's just pretend it's 1.5 to 2.5%. And the Fed can change that, and that's how they can change money supply. So when we say the word administered rates, this will pop up in your notes packet here and here. Administered rates are the rates that the Fed can actually control. Remember the interest rate, the federal funds rate, which was the rate between brother-sister banks, commercial banks with each other. The Fed can't control that. And so they kind of manipulate things around it to try and control it. Administer rates is the opposite of that. The Federal Reserve can control these rates, and they are the interest on reserves and the discount rate. Those are the 2 things they can really, really control. And then ample reserves is when they decide to put their excess reserves into the Fed, and if they can get a really good interest rate at the Fed, then they have no incentive to lend money at another interest rate to other banks or to individuals because they can grow their money in the Fed. And so that happens under ample reserves. Okay, so kind of like what I said yesterday, limited reserves, this is just a recap, not around anymore. From the dawn of time to 2008 is when limited reserves happened, and our 3 tools were reserve requirement, discount rate, open market operations. Ample reserves is what our economy has been operating in under since 2008, and they can change the administered rates, the discount rate, and the interest on reserves, and that will change money supply. So both of these things change money supply, but this is the old way, and they still love to bring it up on the AP test, and this is the new way. And we can't get them mixed up because they are actually 2 different graphs. This is the money market graph, and this is the reserve market graph. And we're going to learn reserve market graph. So here we go. Buckle up. It is obviously the most complicated graph that we will learn this whole time. It's a lot. So first of all, let's talk about like what are the labels? So we have an X and Y axis, which is very different than the money supply. Because we're not just looking at nominal interest rates and quantity of money. We are now looking at, they'll accept two different names here, policy rate or federal funds rate. So you can label the y-axis either one. Remember, federal funds rate is the rate at which like the commercial banks that are all kind of friends with each other can loan money to each other for overnight loans. And then down here is quantity of reserves, not just quantity, it's quantity of reserves, okay? So the demand curve, you will notice, is real funky. It plateaus, drops, plateaus again. And so the demand for reserves is what we label it, demand R. And there's an inverse, which means flip-flop relationship between the federal funds rate and the quantity of reserves demanded. So like how much are they going to put on reserve? In the Fed has like an inverse relationship with the interest rate. If interest rates are lower, they're not going to put as much in the Fed. If interest rates are higher, then they're going to put more on reserve in the Fed. So when the federal funds rate is high, banks will hold less reserves. They're more likely to like loan out to brother sister banks because they're going to make money loaning at a federal funds like that best friend rate. When the federal funds rate is lower, when it's floating down, then banks are less likely to take their excess money and loan it in overnight loans to other banks. They're going to take their excess money and put it into the reserve account in the Fed because they might make better money there. So that's why this is downward sloping. That's a little bit less important. Just know that it's downward sloping. Okay, so then what is this up here and what is this down here? So let's talk about the first plateau. It goes like flat, drop, flat. This first plateau is called the discount rate. And actually on the AP exam, if you do not label this, they don't care, which is insane. They just kind of haven't decided what they want kids to label and not. So right now, as of March 19th, 2026, if you don't label this one, you're fine. So this represents the discount rate. The discount rate, we call it an upper bound. It's the maximum rate that banks are going to be willing to pay to borrow money. So remember, this is the federal funds rate, and let's pretend that these are numbers. So let's pretend that this is like 4%, and then it goes up to 5%, and then 6%, 7%, okay? And let's say that a bank needs a loan, an overnight loan, in order to have enough reserves, okay? If the federal funds rate, the policy rate, the going federal funds rate is 7%, why would I, as a bank, a commercial bank, get a loan for 7% from a brother-sister bank when I could just call the Federal Reserve and get one for 4%? So you see how it becomes an upper bound? No brother-sister commercial bank is going to charge above the discount rate, or they won't get any customers from their other banks who need help. Okay, so we call that an upper bound. The discount rate is a cap on the federal funds rate. And the Fed loves this because then they have more control over the federal funds rate using an administered rate. They are allowed to mess with the discount rate. And so they can kind of control the federal funds rate that way. So that's why we call that the upper bound. Okay, so let's pop on down to the lower bound. The lower bound is the policy rate. And this is another example of interest on reserves. And if you labeled it interest on reserves, they would kind of count it. It's just a big mess. But we're going to label it PR policy rate, okay? But that's what it means. It is the interest on reserves. So this is the interest rate that the Fed uses to control money supply by charging interest on reserves. Not charging, by giving interest on reserves. And so this administered rate, they have the power over it, is like where they're setting this target. If this is how the interest rate that you would, if a commercial bank puts their money into the Federal Reserve in the excess account, they will make this interest rate. And so it becomes a lower bound because you wouldn't want to get a federal funds loan for anything less than that when you could put it into the reserve account and grow your money by that. So we call it a lower bound. Okay, if that didn't make sense to you, just memorize the way the graph looks. So here is where things get like, we can kind of see both come together. So This portion of the graph represents ample reserves because no matter what we do, oh, I completely forgot to tell you this. Hold on, backwards. This is supply of reserves. Kind of think of this like money supply. And the Fed could move it to the right or left. But notice, if I move this over to the right here, and I call it supply reserves 2 with an arrow, did anything change? No, nothing changed. This is because if the Fed uses regular monetary policy tools in this portion of the graph, if they use like open market operations or reserve requirement, nothing's going to happen. No interest rates are going to change. If they moved money supply in this portion of the graph, then interest rates would change. They'd go from here to here. So this portion of the graph represents limited reserves, what the United States was like pre-2008. And this portion of the graph represents ample reserves, what the United States was like post-2008. So just keep that in mind. The lower bound kind of like rules the roost here, and here's where regular like limited reserve tools would work. So ample reserves and interest on reserves and administered rates is how you change this. All right, so buckle up. Here we go. So what should the central bank, do if they want to change monetary policy when we have ample reserves? What should they do? This is where at the bottom of your notes packet, I'm going to ask you to draw these 2 graphs. You're probably going to have to like hit pause on the video. This is basically like a, if I don't understand it situation, I'ma just memorize it. That's what I'm asking you to do. So if anything I said today is confusing, just memorize the graph. Memorize the graph. Because it is confusing for me to say, hey, I'm going to teach you these 3 tools of monetary policy. Oh, guess what? That was a lie. Actually, there's a 4th one, and that's what the United States uses all the time. I'm so sorry, but this is what AP tells me to teach you, so here we go. So there's a problem. Let's say there's a problem in the United States. There is a negative output gap. We are in a recession. Prices are depressed. Unemployment is high. There's businesses are closing doors. Oh crap, what do? We need to expand. In a limited reserve system, we would use expansionary monetary policy by decreasing the reserve requirement, decreasing the discount rate, and buying bonds on the open market to make the money supply bigger. But we are no longer in limited reserves. We are in ample reserves. So what the crap do? I'm going to zoom in over here. So in order to change the money supply and change interest rates in ample reserves, here's what they need to do. They need to take the interest on reserves, the policy rate, and they need to lessen it. So let's say this is like 4% and they lessen it down to 2%. When they lessen the interest on reserves, now banks are like, maybe we don't need to keep our money in the Fed. We could loan it out to another bank or to an individual and make more of an interest rate back. So then they take their money out of the reserve account and they move it to other interest-bearing assets for them, other different loans. If they're giving out loans, that's going to increase that money supply. So it does the same thing, but it's through a different method. They're taking interest on reserve and dropping it down, okay? So here's exactly how we do this. So you're going to draw the regular reserve market graph. So like follow along with me. Give me, I'm going to like bold it in. Supply of reserves, you label it. Give me a kind of like downward sloping situation here. There you go. So in this situation, they decide, hey, this policy rate, this discount rate, everything we can control, their administered rates, their discount rate and their interest on reserves, which we call the policy rate, let's bop that down. And if we bop it down, then banks won't keep money on reserve here. They'll throw money into the economy. So here's how we do it. I'm going to do it in red. Well, actually, you actually need to draw this. So you just got to remember that every plateau has a little like dotted line on it on this graph. So what changes when they decide to bop that down? They can bop down the discount rate and it goes zoop. It follows the line, and then they bop down the interest on reserves as well, and we call that the new demand for reserves 2. This sets a new like target discount rate. So no federal funds rate, no interbank loan is going to go above that. That's the upper bound. And then here's the lower bound, the new interest on reserve rate. No interbank loan is going to go below that because they would just rather put it in the Fed and make that money. But what this does is now banks are going to be like, oh, it's not that much better to keep our money in the Fed. Let's take it out and go loan it out somewhere else. And that's going to juice up the economy. So what you absolutely have to have is you got to have arrows going down, 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 down. And you got to have new labels and new dotted lines. And that's just what makes this graph so difficult. There's so much to it, but it's just maybe just like a memorize and move on kind of situation. Okay, so what does this do? This juices up the economy. There's more money in the money supply system. More loans will be made, then more consumer investment spending, then more aggregate demand, and it's going to close that negative output gap. Okay, so let's pop on over here and let's take a look at what if there's a positive output gap. If there's a positive output gap, then that means that there's inflation, there's overemployment. We are below the natural rate of unemployment. Our economy's like really heating up and we need to cool it down. We need to hit the brakes. So in an ample reserve system, how does the government do that? We know that in a limited reserve system, they could increase the discount rate, sell bonds on the open market. Selling bonds makes the money supply smaller, or increase the reserve requirement. But we're not in limited reserves anymore. We're in ample reserves. So how does the graph start? It starts where I am drawing in black right now. It starts with that like little plateau, drop, plateau, and your dotted lines that represent your discount rate up top. And you can label this discount rate if you want to. You don't have to label it. And your policy rate on the bottom, which is another way of saying interest on reserves, your IOR. Okay. So how can they slow down the economy? They need to take money out of the money supply. But if they just move money supply, using the three regular tools, it's not going to work. We're in ample reserves. So they need to change the two rates that they have control over, the discount rate and the interest on reserve, the policy rate. And if they do that, that's going to take money out of the system and slow it down. So the first thing they do is raise that discount rate up. Let's do our dotted line all the way across. And when they raise that discount rate up, we're going to put an up arrow right here. You can put one right here as well. That makes it so that banks will probably charge a higher federal funds rate as well. And that will kind of slow down banks loaning to each other. The next thing they're going to bop up is the policy rate or the interest on reserves. So I'm going to do that dotted line all the way across with an arrow. And they are incentivizing, saying, hey, put your excess reserves in the Fed and we'll pay a little bit of an interest rate. And so that money is then kind of taken out of the system, decreasing that money supply, and thus kind of slowing down the economy. Now, we're not done yet because we have to draw the new demand curve. So here's, oh, I forgot an arrow here too. Here's our new demand curve. It's up above, it swoops down, and it plateaus again. Okay, and we call that demand for reserves too. So there is now a greater demand to put reserves in the bank. And the federal funds rate now is going to be pushed up, and they're kind of controlling and manipulating that federal funds like interbank loan rate. And we label it PR2. You could also label it interest on reserves. There's so many different labels. So what does this do? It takes money out of the system. Banks aren't going to loan to each other as much. Banks are going to put their excess reserves into the Fed account instead of loaning it out, and that's going to slow down the economy. Less loans, less consumer and investment spending, less aggregate demand, and we're going to close that positive output gap. So that is administered rates and the ample reserve graph, and I hope that you had a fantastic time with that.